Okay, great. Good morning, everyone. Welcome back. Hopefully we're into warm weather now, and Saturday was the last of our snow. So today we are going to be starting Chapter 8, and I want to take a minute and talk about schedule in general. We are covering Chapters 8 through 13 in the next 5 weeks, and that sounds like a lot, but these chapters, especially 11, 12, and 13, are very small. So these are not big chapters like some of the earlier chapters, so it works. And so we are going to be doing Chapter 8 today. We may be starting Chapter 9 Thursday. I'm not sure on the timing, so we might be a little bit ahead of what it says on the schedule just because we might have extra time going on this week that we'll need later. So we could be working ahead a little bit, so don't be surprised. So we Chapter 8 today. We may do Chapter 9 on Thursday. What's due this week, this Saturday? Attendance Quiz 18, which of course covers today and Thursday, Chapter 8 homework in My Accounting Lab, and then Sunday the video quiz 19 over Chapter 9 in Blackboard. So those standard assignments will be with us for the rest of the semester. Okay, tutoring this week. I sent out an email yesterday for tutoring sign up. We have tutoring Tuesday, Wednesday, Thursday this week. Next week we'll also have it on Monday. It feels like a long time ago since before spring break, but Exam 2 results, I wanted to share some things with you. The average was 70% on Exam 2. The scores ranged up to 110%. If you would like to see the list of scores, this is the URL. It's http://tiny.cc/exam2FA spring. Financial Accounting Spring is where I came up with that. Okay, so tiny.cc/exam2FA spring. That is an Excel sheet, and it lists the exam scores. And you can see where your exam ranks within there. If you want to go over your exam, you have the opportunity to go over your exam with Brian this week. He has time set up for Tuesday, Wednesday, and Thursday this week. Today from 4 to 5 p.m., Wednesday from 2 to 5, or Thursday 1 to 2 p.m. So he picked a variety of times. If you absolutely cannot make any of those times, email me, but this is the week to see your exam. So those are the basic times: Tuesday 4 to 5, Wednesday 2 to 5, Thursday 1 to 2, and you would go to room 579 in the College of Business on the 5th floor, and that's where Brian will be during those hours. Okay, and I think that's it for administrative announcements. We're going to get into the material now. Chapter 8, which Chapter 8 is about long-term investments. So what we've done so far to kind of position where we are is we have gone down the balance sheet. We started with cash, which is at the top of the balance sheet, and then we did accounts receivable, we've done inventory, we've done property, plant, and equipment, and intangibles. Now we're into long-term investments, which are an asset, and they're near the bottom of the assets. They're one of our longer-term assets. And in this chapter, we're talking about this asset long-term investments. Now, this chapter has 6 learning objectives, and remember how I said we're doing chapters 8 through 13 in the next 5 weeks? These chapters are small. In particular, this one, we're not covering 3 of the learning objectives. We are only covering 3. We're covering learning objective 1, learning objective 2, and learning objective 6. So that's what we're doing in this chapter. You're not responsible for the other learning objectives. So those are, and that's what would have been in the video lecture. That's what's in study plan. So these other 3 learning objectives that we're not covering, you will not see appear anywhere. As I said, long-term investments are on the balance sheet, and where they are specifically on the balance sheet, when we look at a balance sheet, our first item on the balance sheet is going to be cash, and then we have short-term investments because those are close to cash. Then we have accounts receivable, inventory, prepaid expenses. Those are all current assets. And then moving down, typically long-term investments are next. There is some debate whether they go before or after property, plant, and equipment and intangible assets, but they're down in the long-term section, not in the current assets. So short-term investments are in current assets. Long-term investments belong down in the long-term section. We're going to be talking about bonds in this chapter. In bonds, there's two sides to every bond. We have the bond holder, who's the investor. I can go buy bonds in IBM, and those are an investment for me, but for IBM who issued the bonds, those are a liability. So the investor, so we can talk about a bond as being an investment or being a liability. The investor has an investment in bonds, which is an asset, and the investor has interest revenue. On the other hand, the issuing company, the company that issued those bonds, has a liability called bonds payable and has interest expense on those bonds. So we are not dealing with the liability section in this chapter, but the accounting for the two will pretty much be mirrored in many ways. But on one of them, so we can talk about a bond as being an asset, but a bond can also be a liability depending on which side of it you're looking at. My next slide is a review from the video lecture, just because we're going to go into a homework problem and I want to just have some common understanding. Available for sale investments are investments that a company holds available for sale, is basically what they are. They can be debt securities, so they could be bonds. We could buy bonds in IBM, and that would be a debt security. Or equity securities, meaning stock in another company. When we buy available for sale investments, they are recorded at cost, so whatever we paid for them was what that goes on the books for them. Generally accepted accounting principles require that those available for sale investments we adjust to current fair market value at the balance sheet date, and then we carry them at current market value. So these are stocks that are trading on the New York Stock Exchange or wherever they're trading. They're bonds that might trade. They have a fair market value, and that's how we carry them on our balance sheet. Whether we classify something as available for sale or held to maturity has to do with our intention. So this is where management says, we intend to hold these for sale. So with that, we're going to do an exercise that deals with these available for sale investments. So this is a good exercise in terms of giving us some sample transactions. And these journal entries I would definitely put on my review sheet. Now, I'm going to be talking about the review sheet again because our final exam is coming up in 5 weeks. Know that our final exam is not comprehensive, but it does build on prior material. So our final exam is chapters 8 through 13, the parts that we cover. Okay, so this is an excellent example of some of those basic journal entries. We have a company that just did these investment transactions, and we are told to write the journal entries, and then we have some other requirements. So the first one says April 10th, 2012, we purchased 600 shares of Tycon stock paying $17 a share. Okay, so for that first transaction on April 10th, we're going to write a journal entry for that. Okay. Now, when we purchase 600 shares of stock paying $17 a share, when we figure out how much we purchased then, that is 600 shares times $17 a share. So what we're giving up cash, so we're going to credit cash, and we're getting an investment. So our journal entry is going to be to debit our investment, and in this journal entry I'm showing here, I'm calling it available for sale investment, but it would just be an investment. The 600 times 17 is where I got the 10,200. The 600 times 17 is not part of the journal entry, but that's an asset we're debiting because we're increasing it. And we are crediting cash. So cash, we're spending cash. We're buying this investment. And management intends to hold the investment So that is our journal entry when we purchase something, when we purchase an investment. We're going to debit the investment, credit cash. Okay, the next transaction down says on July 22nd, we received a cash dividend of $1.24 per share. So we're getting a $1.24 dividend, and we have 600 shares. So $1.24 times 600 is going to be $744. So what we're doing on July 22nd is we're recognizing that we're getting cash of $1.24 times 600, and that cash, so we're increasing cash, and the credit then will be to dividend revenue. So we're going to debit cash for $744. We're going to credit dividend revenue for the $744. And again, 600 shares at $1.24 a share, that's simply showing you how we got the number. It's not part of the journal entry. So far we've done 2 journal entries. We've done the first journal entry April 10th was for purchasing the investment. The second journal entry on July 22nd was to recognize the dividend income revenue off this. And now our third journal entry tells us that on December 31st, we adjusted the Ticon investment to its current market value of $5,500. So in this case, what we're saying is we bought it. When we bought it for $10,200. Now it's only worth $5,500. So it was $10,200. Now it's $5,500. We've had a loss on it. So the first thing we need to do is calculate the amount of the loss. So we purchased it for $10,200. We have a current value they told us of $5,500. The difference between those two is $4,700. And that's an unrealized loss. That word unrealized is key here. We've seen it before, but unrealized means that we still hold this stock. We have not sold it. And that's a signal to anyone using the financial statements that this loss is based on something that's still on our balance sheet, so it has not occurred for sure. Okay, so that's our calculation for this journal entry on December 31st. The actual journal entry we do on December 31st for a loss is going to debit unrealized loss on investments, and it's going to credit an allowance account. So wait till that comes up, and then I'm going to pause for a minute, let you write that down, and then I'll talk about it. So there we go. So I'm going to pause for a minute, let you write that down, and then I'll talk through this a little bit more. Darian, I'm going to answer that question in just a minute when I walk through about what we do if it's a gain. What we have here, that first account is unrealized loss. An unrealized loss doesn't go on our income statement per se. It goes on the special statement, which again, I've got a slide coming up on that called Other Comprehensive Income. But the credit here is to allowance to adjust investment to market. Allowance is a contra asset account. This allowance is going to reduce the amount of the, it kind of, it's hard to say what it is. It's contra equity actually, is it? Mr. CPA exam? Yeah, that is a contra asset, yeah. Okay, so we have this unrealized loss and we have this allowance, which is a contra asset, reduces the asset. Now, this is because we have a loss. So in your notes, you may want to put a little circle saying loss. This is an unrealized loss because on the balance sheet date, the market value of this investment is less than what we paid for it. Now, if the opposite situation occurs, and this is Darian, this is your question. If the opposite situation occurs where we have a gain, where it's worth more than what we sold it for, this journal entry is kind of backwards. If it's a gain, we're going to debit the allowance account, and then we'll credit unrealized gain. So this journal entry is backwards, and instead of loss, it says gain. So I think we have an example of that coming up. But this is a loss journal entry as it's written. If it were a gain, it would be flipped, reversed, and it would say unrealized gain. Those three journal entries that we just did are pretty good examples of the journal entries we'll do for investments. Now we move on to requirement 2, which requirement 2 says assume that this is their only investment. Explain how these transactions will be on their income statement and on the statement of other comprehensive income. So this statement of other comprehensive income, it's this little extra statement that includes some things that are non-standard. So I'm putting up the exact solution answer here. The income statement has the dividend revenue on it. The statement of other comprehensive income, the second thing in that requirement 2, has an unrealized loss of $4,700. So those two items, one goes on the income statement and one goes on the statement of other comprehensive income. And then the final part of this exercise says show how to report the investment and any unrealized gain or loss on their balance sheet. So this next one, I'm going to just, it will eventually show up, and it's showing a balance sheet to show where these items are. So I'm going to pause again for a minute or two, let you write it down as it loads, and then I'll talk about it. This is a partial balance sheet. So we see our long-term available for sale investments. They're reported at the current market value. That's what they told us they were worth. So that's what they go on the balance sheet for. On stockholders' equity, you're going to see that unrealized loss on investments. It's shown with brackets around it because it's a reduction in equity. This is an unrealized loss. The word unrealized means we still hold this. That's a signal to investors that this is not completely finalized, that that investment could continue to change value. If this were a gain, it would be unrealized gain. It would not be in parentheses, and it would be added into stockholders' equity. But because it's a loss, it reduces stockholders' equity. Again, when we see the word unrealized, that means we are still holding this underlying investment. And that does it for exercise 1. Now, we have a couple multiple choice questions coming up here. I do want to say before we get to that, well, see the answer choices where it says ST, that's short term, LP is long term. So on January 1st, 2012, Plymouth Company purchases 100,000 6% bonds at a price of 90.4 and maturity date of January 1st, 2016. And it asks us for the entry to record the purchase of the bond investment. So I am going to go quiet. I'm going to watch for people to finish writing it down, and then we'll talk about how we would do this. I feel like we should have the Jeopardy music playing. Yeah. Yeah. By the way, we have 2 multiple choice questions here, and the next one builds on the same question. It just has a different last sentence. So, okay, for this one, let's talk about what we're told here. We're told January 1st, 2012, they purchased $100,000 of bonds. $100,000 is how much they're going to get when these bonds mature. So they're making an investment, they're purchasing an asset, and the maturity value is $100,000. 6% refers to the annual interest rate on these bonds. When you see a percentage, that refers to the annual amount. That's not a semi-annual. That's the annual amount. At a price of 90.4. 90.4 is 90.4% of the face value. The face value is $100,000. Then it tells us that interest is paid semi-annually twice a year, and they have a calendar year end. And then when we go to record the purchase of the bond investment, what we're going to do is we are going to, the answer is actually debit long-term investment for $90,400. When we purchase these things, we are going to debit long-term investment and credit cash. So this is just like the homework problem we just did. We bought an investment. So we're going to debit long-term investment. We're going to credit cash. The amount of that journal entry is the price. The price is always quoted at 90.4, 101.2, but it's a percentage. So 90.4% of the face value or principal is $100,000. So the amount is $90,400. We record investments at the cost. We have one more question that builds on the same fact set. So the only thing changing in the next question that I'm putting up is the last sentence. So same bonds that were purchased, and now the question is asking, what journal entry do we make when we receive interest? So the bond, we have the purchase of the bond, we receive interest on it. Bonds pay interest. So when we receive that interest, what would we do? So when we receive interest, what we're going to do is we have to calculate the interest amount. And the interest amount is going to be the face value of the bonds, the $100,000 times the 6% times 6 months out of 12. This is semi-annual. We get interest twice a year. That interest rate that we're given is quoted for a whole year. So we can do this a couple ways. We could take the interest rate, divide by 2, but probably an easier way is to take the interest rate times the principal times the number of months this is for. It's possible we could have to do a journal entry for 2 months or 4 months or whatever. So 6% our stated rate, our face rate. 100,000 is the face value times 6 months out of 12 because this pays interest twice a year gives us 3,000. And what we're going to do in that journal entry is we're going to debit cash and we're going to credit either interest receivable or interest revenue. In this case, 99.9% chance on this one that we're going to credit interest revenue, but I wanted to put interest receivable there because that's a possibility if you accrued for this ahead of time. So in this particular one, we're going to debit cash for $3,000 and credit interest revenue for $3,000. Now, what's up next is we're actually on Learning Objective 6. This is a very small chapter for us. So Learning Objective 6 talks about the time value of money. The time value of money says that money is worth more today than some future sum. The principal is the amount that we borrowed or invested, and discounting is the process of calculating what something's worth today. It's future value. I would rather have $1,000 today than $1,000 5 years from now because I could take my $1,000 today and invest it and have more than $1,000 in 5 years. So we have to think of time value of money, money having value over time. It's worth more today than in the future. And we're going to be calculating what things are worth today. So if we say we're going to get $100,000 5 years from now, that's not worth $100,000 now. What would I have to invest right now to have $100,000 in 5 years, which is another way to look at it. So this process of calculating the present value is called discounting. And this is where we talk about present value. If you have a financial calculator, you'll see a PV function. If you use Excel, there are financial functions. And you can use Excel for this as well. In this class, when we do our calculations, we're going to use tables because I am not going to require everyone buy a financial calculator for 1 week of the class. That wouldn't make any sense. You also may not always have Excel available at your fingertips. What everyone does have are these tables. So the exercise that we do in here today, we'll use the tables. In My Accounting Lab, there is a pop-up window that will show you the tables. You can click on which table you want. And there are 2 tables we use in this chapter. There are actually 4 tables at the end of the chapter. 2 are present value and 2 are future value. We are not covering calculating what something's worth in the future. What we're concerned with from an accounting standpoint is what are things worth today when we have to do our journal entries and things like that. So we will be using the 2 present value tables. So when you're presented any of these homework problems at all, you can immediately cross off the future value tables. We are only using the 2 present value tables. So one table is on page 487, and it's the present value of a dollar table. And this is when you have one lump sum. We're going to go through an example. So page 487, present value of a dollar, that's one table. The other table that we're using, it looks very, very similar. The numbers are different though. It's on page 488, and it's the present value of an annuity of $1. So we have these 2 tables to select from. One's the present value of a dollar, one's the present value of an annuity table. So we have those 2 tables. Our big challenge in every problem that we have is deciding which table to use. And that is, so we know there's 4 tables presented to us. We know that for what we're doing, only 2 of them will be relevant, the present value of a dollar and the present value of an annuity table. There are certain rules about which table you use to do what. Present value of a dollar table is used when we have a single payment or a single cash inflow. When we talk about a single payment, it can be a single amount we're receiving, or it can be a single amount we're paying, but it only happens one time. So the present value of the dollar table is when we have one amount of money. It doesn't happen over and over. The present value of an annuity table or present value of annuity of $1 table, that's when we have 2 or more payments equal amounts. So we're either paying the same amount for 2 years or more, or we're receiving the same amount every year. So those are the rules about which tables to use. Now we're going to do a homework problem right now that illustrates which table. It has an example of what something looks like from each table. As an aside, on your homework this week, there are 2 homework problems. This is one of the shortest homework weeks we have all semester. It was the exercise we just did with the investments, and then it's this one coming up, very short. So just know that the homework is easy to knock out. And after today, we'll be done with the homework for this week in terms of class, so if you want to do it. If we have payments that are not equal amounts, then they have to each be treated as a single payment. So short exercise 8-9, we want to calculate the present value of the following amounts. So what we're going to do in this exercise is we're going to use the tables. We're going to decide which table we use, and we're going to use them to calculate the present value, because we need to calculate what things are worth right now. So the first one, calculate the value of $10,000 at the end of 5 years at 8%. So what that's telling us is this pays 8% every year. We can assume that 8% is annual, and the $10,000 is what we're going to get at the end of 5 years. So the first question is, which table do I use? And when we go through, here's our two choices. We have the present value of a dollar table, and we have the present value of an annuity table. The $10,000 is only received one time. So that's going to be a single payment. So we would use the present value of a dollar table for that one. It's just telling us we get $10,000 one time. So then how do we use the table? So we know that we're going to use the present value of a dollar table. And what we're going to do is we will switch to that table right now. So on page 487, if we were doing this, we would open up our book and turn to page 487, or we could also, in My Accounting Lab, there'll be pop-up buttons that you can click for which table you want. So in this particular case, we're doing the present value of a dollar table. What we're going to do is we are going to locate 5 for the period, it's 5 years, and 8% for the column. So you find your percentage across the column, you find your row for the number of years, and we see a factor of 0.681. So what we do with that 0.681 is we take the $10,000 times the 0.681 to get our present value. So what we'll see is 10,000 times 0.681 gives us a present value of $6,810. If you have a financial calculator, you could put 10,000 in as the future value. You could put in 5 years and 8%. And you will get a number that's close to that, but it'll be more precise. So it would be 6,800, I'm going to guess here, 112.98 or something like that. It'll be much more precise. The table rounds these factors to the nearest 3 decimal points. In reality, you can get tables that have 10 decimal places. When you use a calculator or when you use Excel, you're actually being much more precise than the table. But for our purposes, the table will work fine. If you want to use a calculator or Excel for your homework, you can feel free to do so, because My Accounting Lab is programmed to accept either the exact precise answer or the answer that you get using the tables. That said, when you take your exam, it'll be using the table. So you do need to know how to use the tables. The tables will be provided to you in My Accounting Lab if you need them. Okay, so it's all electronic. But if you have a multiple choice question, you can assume that it's using the tables. And they'll be close. You'll be able to pick the closest answer, but know that if you use one of these other tools, your answer will vary a little bit because it'll be a little bit more precise. Okay, so that is part 1, the $10,000 at the end of 5 years. That's one lump sum. We use the first table. The second one here now, part 2, $10,000 a year at the end of the next 5 years. That's what that is. That's an example of an annuity. That's the present value of an annuity because we're getting $10,000 every year. When you see that $10,000 a year, that's telling you you're getting $10,000 every year for the next 5 years. So we use the annuity table when we have a series of equal payments. If those payments are exactly the same, we use the present value of an annuity table. If those payments are different amounts, if we got $10,000 this year, $20,000 next year, those we have to treat as individual payments. Now I like Rhonda's question here, and I'm seeing Brian type an answer, so feel free to answer, Brian. But I'm going to jump in here. And this is kind of confusing to think about. If we think about a timeline, what something's worth right now is its present value. What's it worth to me right now? What would I need to invest right now to have that $10,000 I'm going to get at the end of 5 years. When you're asking, she says, I don't understand how our $1 can decrease over time. If you put $1 in a savings account, it'll be $1 in the future. Well, actually, it's a little more in the future. It's not, if you put $1 in a savings account, remember we're assuming we earn interest. You're not probably going to earn interest on $1. So these are bigger amounts, but you put money in the bank and it grows. So its future value, let's assume for the sake of argument that you would earn 5 cents interest. So you put that dollar in the savings account today, and a year from now you would have $1.05. So that future value is $1.05. Its present value is $1 because things grow interest over time, so they're worth more. So the future value is higher. Our future value of that dollar that you're talking about, Rhonda, is $1.05. It's not $1. There is interest. Okay. Brian's shaking his head at me. Okay. Yeah, the tables will be provided in whatever problem you're doing. If you need the tables, they will be given to you on the exam. So you don't need to worry about bringing them, but just know that they will be given to you if you need. They'll be available if they're needed. Okay. Okay, so the second part, the $10,000 a year, that's an annuity because we're getting $10,000 every year for 5 years. So how we use this then is we go to the present value of an annuity table. And when we go to the present value of an annuity table, we go to row 5 and the 8% column, and we'll get a factor. And our factor, row 5, 5 periods, and 8% is 3.993 will be our factor. So that 3.993. What we're going to do with that then is we will take our $10,000. We always take the amount of the annuity, the $10,000 times the 3.993, and we get $39,930. And that's the present value of that annuity. That annuity, we're getting $10,000 every year for 5 years. You cannot just take 10,000 times 5. You need to figure out what it's worth in today's dollars. Another way of looking at this is if I invest $39,930, I will have $50,000 at the end of the 5 years. That's what the present value of that $10,000 every year is, $39,930. The big key, so that's that homework exercise. You can see we've done the 2 homework exercises today. They will go very, very quickly. They're very straightforward. The big key on this time value of money stuff is being able to pick the right table. Do we have a present value of $1, which is an annuity, which is one amount we're getting, or do we have an annuity, which is the same amount 2 or more years? We're going to leave this homework exercise now, and we've got a series of some questions here. Wow, okay, that didn't load very well. We see the answers to the question. I did already. I'm waiting for it to reload. There we go. Okay. So the first question, unrealized gains and losses. So this is back to what we did in the beginning today. From available for sale investments arise from what? The purchase of an investment, the sale of an investment, changes in the market value of the investment, or management's decision to adjust the value of the investment. Your dollar is worth more in the future, Rhonda, in terms of just your dollars. The dollar you have today is worth $1.05 a year from now because it grows interest. Okay? Inflation is not part of the time value of money. Inflation is another conversation. And Brian, you just do whatever. I won't answer anymore. But I am going to go around and get answers for this one. Okay. See? You sound confident? Great. Great. D? Okay. C? 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 Okay. Brian, what do you have? Okay, so a bunch of C's, and C is the answer. When we talk about unrealized gains and losses, that word unrealized means we're still holding it, okay? And when we still hold it, we have unrealized gains and losses arising from changes in market value. D is not the answer because management's intent to hold or not tells us we need to adjust, but management doesn't make the decision to adjust. That adjustment's done automatically based on market value if this is a held for sale security, available for sale. Okay, so changes in the market value, unrealized gains and losses arise from that. We're still holding it. At the bottom, if we have a realized gain, now remember, realized gains and losses do not say the word realized. If you have just a plain gain or just a plain loss, it's considered realized, meaning we sold it, okay? And that gain or loss is finished. Okay, on the maturity date of the bond, so now we're combining bonds and time value of money. The bondholder will receive the bond's present value, true or false? What do you think? What? True? What do you think? Okay, you're going to say false. Okay, so split decision here. Okay, on the maturity date of the bondholder will receive the bond's present value. What do you think? True? What do you think? True. True? What? True? Okay. I'm going back to you. I'm going to stand by you. You said false, right? Okay. Maybe it's this side of the room. Okay. The answer here is false. Okay. And let's talk about why. Present value is what it's worth today. Maturity value is in the future. So let's go back to the dollar and the $1.05. Okay. Let's say we have $1 and we're going to invest it at 5% interest for a year. So this kind of goes to Rhonda's discussion too. Okay. So if we have $1 in our hand right now, the present value of that dollar is $1. It's worth what it is we have this dollar. But that dollar in the future will have interest on it. So after a year, our dollar's worth $1.05. That's our future value. That $1.05 is also the bondholder receives the bond's present value. If we were using our dollar and our $1.05 in that example, what this is saying on the maturity date of the bond, our bond's $1. The bondholder will receive the bond's present value. The present value is $1. We're holding it today. No, the bondholder will receive $1.05. It's not going to receive what it's worth today. So the present value is what it's worth today. Maturity value is in the future. Maturity value will be higher than what it's worth today because things gather interest over time. But the present value of $1 in your hand right now is the dollar. Okay? It's over time it accumulates interest. So the present value is going to be less than the future value. But if we have it in our hand right now, the present value is what it is in our hand. You still typing? Okay. Oh, yeah. Okay. Okay. Okay, another one here. And again, this is looking at the slight differences in language. The process of determining the present value is called discounting because the present value is more than the future value. True or false? Haley, you. Oh, okay. Got it. And for this particular one, the answer is false. It's because it's exactly opposite. The present value is actually less than the future value. Our present value is going to be less than the future value. That's why we call it discounting. So this one's false. If I had said the process of determining the present value is called discounting because the present value is less than the future value, then this would have been true. Okay, another question. The principal is the amount borrowed or invested. True or false? And this is true because that is vocabulary principal is the amount borrowed or invested. If you go take a loan out at the bank, the amount that you borrow is the principal. And that brings us to the end of Chapter 8. So I think this is a good place to break. I don't want to start Chapter 9 right now. So on Thursday, we will be starting Chapter 9. We have done all the homework in class for Chapter 8, so you can start on the homework. And I will see you on Thursday. Right.